This week's week ahead report is divided into two sections. First, a general overview of the market. Second, more specific guidance for Monday. The market has been on a tear to the upside, fueled by AI, positive inflation reports, and big bank earnings that easily beat expectations. The last upside breakout level came from 4,500. That breakout level now becomes support. For several weeks, we have been talking about the pain trade. The pain trade is fueled by larger pools of money being underinvested or too conservatively invested. That appears to have been the case. There is no way to tell if that situation has rectified itself. We do have pretty good evidence that the retail is very long, CTAs are long, and hedge funds are short. With the hedge funds being short, if our information is correct, that still leaves room for more forced short covering. Beginning next week, we start to see the earnings report from the smaller or regional banks. What was positive for the major banks is more likely to be negative for the regionals, as during the last crisis, money flowed from the smaller banks into the major banks. Also beginning next week, the market is more likely to begin focusing on the FOMC meeting for the following week. Specific guidance is centered on the market's ability to hold above the 4,500 level. The first graphic we looked at, showed the upside breakout from the 4,500 level. The larger question is, will the upside breakout remain, or will we be looking at a look above and fail? The second graphic, which gives us more specific guidance for next week, is a late downward spike that appeared on Friday afternoon. Thursday afternoon, I thought I saw the first evidence of more serious type of selling. There was some follow through from that on Thursday evening. Then a little more confusing as the market rallied on Friday morning. My guess is the rally on Friday morning was more retail centered, as retail traders tend to look, right over the hood at the big bank earnings. The larger money had probably already anticipated that those earnings would be pretty much as expected. Late Friday afternoon, we had a downward price spike. A downward price spike occurs late in the day, and there's not enough time left for the market to verify if that spike is accepted or rejected. For Monday morning, the spike trading guidelines are applicable. The strongest response to the downward price spike would be for the market to open and remain above the top of the spike. That would tell you that prices had gone low enough to cut off the selling. Opening and trading within the spike is neutral to negative. It's showing the price was being accepted, but there's a lot of leeway in there for short-term adjustment. The most negative response from a market standpoint would be for the market to open and trade and remain below the low of the spike. That would communicate to us that the market had not gone low enough to cut off the selling. Thank you. Have a great week.